Hello and welcome to this video. I'm Milind Date and I'm the expert tutor for the AFM examination. In this video, I would be covering some important aspects about the Black-Scholes model used in the financial management function. Remember, this is not a teaching video, but it is expected to provide you with some AFM examination tips and tricks for you to be able to take the examination with confidence. Well, before we start the discussion on the model of Black-Scholes option pricing, let us see how it's included in the syllabus of the AFM examination. So the syllabus clearly states option pricing models to be looked at from different viewpoints in multiple areas of the syllabus. Although it's one section that deals primarily with it, section B, which is related to investment appraisal decision, advanced level of investment management decision, where it's included as a part of real option archetypes and also in making the estimations about value of equity and debt, as well as for company to work out the probabilities of default risk. Now, let me first start by giving you a tip that it being related to options, students need to bring back your learnings from the FM paper, where you understood the concepts of option contracts as a part of your section of the syllabus related to currency and interest rate risks. Once having revised that, well, you would appreciate that option pricing models were originally devised and developed for valuing market-traded financial products, financial options, or financial derivatives to be precise. But then experts in financial management area, modified these option pricing models to a certain extent and tried applying them to the investment appraisal decisions, as well as valuation of financial instruments such as debt or equity. Now, this video will not cover in details the application, but I'll let you know where all it can be applied in investment appraisal decisions. Well, for learning, apart from the study text, which you may be probably using, you can find it on one of the very, very useful resources provided by ACCA, that is ACCA Study Hub. You can refer to chapter number 13.3, that is subsection 3 of chapter 13 of the ACCA Study Hub for AFM paper. So that's where you will find your learning resources. Let's now look at the option pricing models that are available. They're basically mathematical models. And these mathematical models were developed initially to estimate value of a traded options. And based on specified variables that affect valuation, a formula of valuation was devised. It was developed basically by Fisher Black and Milind Date, and that's why it's popularly known as Black-Scholes model. Of course, apart from this model, the other models that are used are binomial model, which is based on binomial theorem, but that's not the part of AFM syllabus. And second one is Monte Carlo simulation model. Although Monte Carlo simulation model is included in the syllabus, the students are not expected to carry simulations in the examination as such, but only they are supposed to interpret the results that will be probably shared with them as a part of exhibits. But this video is restricted only to the discussion on Black-Scholes option pricing model. So very quickly, you should revise what's an option contract, which of course is a derivative contract because its value is derived from the underlying asset, which could be, shares, commodities, currencies, etc. And naturally, it has two parties, a buyer and a seller. A buyer has a right to either buy or sell the underlying asset at or during specified period of time at a certain pre-agreed price. So the peculiarity of an option contract from buyer's point of view is that the buyer only has a right but no obligation to perform, whereas the seller has only obligation to fulfill if buyer decides to exercise the contract, exercise their right. And the price of the contract, which is typically called premium, option premium, is payable by the buyer to the seller, and that's payable upfront on signing of the contract. You would have obviously learned two types of contract. A right to buy anything is call option, and right to sell anything is a put option. And these intricacies you would already have covered in your FM knowledge, but for the purpose of revision, I have mentioned it in this video as well. Call option, as I said, gives buyer the right to buy an asset which is currently selling as a certain price called a spot on a specific day or during a specified period at an agreed price, which is called as exercise price. Now remember, spot price and exercise price are the concepts that are important for you when you apply the Black-Scholes option pricing model. Similarly, put option, the concept of spot and exercise is same, but instead of right to buy, here the buyer of the contract gets a right to sell a certain asset. So if this option is agreed to be settled on a specific date, it's called as a European style option. It's a convention. There is no legal definition, but it's just a convention. Whereas if the option is agreed to be settled on any day within a certain time frame, it's called as American style option. Now, please remember, as originally developed, the Black-Scholes option pricing model was developed primarily only for European style options, which has to be settled on a specific agreed date in future. Now, obviously, after signing this contract, the buyer of the contract will view his or her position on the date of expiry of the contract and then decide whether it's worthwhile exercising the contract or let the contract be lapsed. If it is lapsed, the only loss that the buyer can have is the premium that the buyer has paid. But in case it is favorable to him and it is exercised, there is unlimited upsize that is available for the buyer. So for a buyer, obviously, the buyer of a call option, if the spot price is greater than the exercise price, that means he has to pay more in the market on the date of expiry, but he has already agreed to buy that underlying at a lesser price, which is exercise price, then it is better to exercise. This is called option in the money. Reverse, if spot is lesser than exercise on the date of expiry, it is better to let the option lapse. So in this particular case, the intrinsic value of the option is the difference between spot and exercise, where spot is greater than the exercise. And that can be unlimited amount of money for the buyer. So intrinsic value refers to the difference between spot and exercise on a positive side. So it's the maximum value between 0 or the amount of difference between spot minus exercise. In put option, it's exactly opposite. The intrinsic value is maximum of exercise minus spot or 0. So mathematically, this is how you can put it. The value of a call option is maximum spot minus exercise or 0. Naturally, for put option, it will be maximum of exercise minus spot or 0. And the premium that has to be charged for an option will be, of course, decided by the market based on variables in the option contract. And two of those variables we have already talked about, spot and exercise. But apart from that, the crucial variables will be the time of delivery as agreed. 2 months, 3 months, 4 months, time to delivery. Between the date of signing contract and the period of time over which or after the expiry of which the contract can be exercised, the prices of underlying will keep fluctuating. So the volatility in the prices of underlying will keep on affecting the value of the contract for the buyer as well as seller. So this volatility is a part and parcel of the variable that's going to affect the value of contract. And the risk-free rate of return, which is generally used as a discount rate to calculate the present value of exercise price, which is payable in future, right? So total 5 variables affect the value of the option, both call as well as put, in one way or the other. Spot price, exercise price, time, volatility of a price of underlying, and risk-free rate of return. Let's now look at how the Black-Scholes option pricing model works. The formula, of course, is developed to calculate, as I said earlier, the value of a European option. Logically, we know value of a call option will be benefit that the buyer will get from spot price minus the present value of the exercise price. Students, I appreciate that this is highly technical, but that's how it is. If you want to be a professional finance manager, finance professional, then you must acquire the knowledge in as much depth as possible about how things actually work. And to a certain extent, you will be able to understand it by taking this AFM examination, because that's how practically you will be exposed to the scenarios wherein you will have to make recommendations or take decisions whether or not to go ahead with a certain plan of action. So coming back, benefit from the spot and the present value of exercise price that buyer will have to pay will be nothing but value of call. If you look at the real market scenario, prices of the underlying will, as I said, keep fluctuating almost continuously. And therefore, continuous discounting is used to calculate this present value. Normally what we use as discount or present value factors are those factors which are at the end of a certain period, end of 1 year, end of 2 years, end of 3 years, like that. But in this case, because the prices will keep fluctuating continuously, continuous discounting is used. Both parts of the formula, that is spot price and the present value of exercise price, are adjusted with risk-adjusted probabilities. Now, what these probabilities are and how the formula looks like, let's quickly see. Of course, you don't have to memorize this formula, number one. Number two, it is available to you in the formula sheet, which is shared with you in the CBE environment. But more appropriately, number three, for AFM paper, a pre-programmed spreadsheet is available, wherein you will just enter these 5 variables that I spoke about, and you will directly get the values of call and value of put options. So it's not anymore requiring you to perform all the complicated calculations using your normal distribution tables, using your scientific calculators or financial calculators. No, all that is gone, because AFM examination is now all about application rather than or deriving the values you using complicated formula. And therefore, you have the advantage of using the pre-programmed spreadsheet to answer the questions on Black-Scholes option pricing model. But of course, please therefore learn all variables so that conceptually you are clear. And in the real examination, you will have to identify the variables correctly and interpret the results perfectly to be able to provide correct answers. So let's look at what the formula of Black-Scholes option pricing model is and how it looks like. It says value of a call option, C stands for call, is, as I said, difference between the spot and exercise. The P subscribed A is spot option, spot price, and P subscribed E is exercise. That's how the nomenclature is. But then both are multiplied by certain parameters. One is ND1 and the other is ND2. Now, ND1 is called as the delta of the option. Delta refers to change in the value of the option in response to change in the price of underlying. Both are, of course, related to each other. And ND2 is the probability that the option will be exercised by the buyer of the option, and because only buyer has a right to exercise. So buyer will exercise only when the option is in the money. In the money means it's in profit for the buyer. And then the whole thing is multiplied by the statistical constant of E raised to minus RT, where R stands for risk-free rate of return and T stands for time. And this is added to find out the present value based on continuous discounting, as I said. R, of course, is the risk-free rate of return. Time is always stated in terms of number of years. So if it is 3 months, it is 1/4 year. 4 months is 1/3 of a year. What is crucial in the examination for you is to correctly identify those 5 variables, PA, PE, R, T, and standard deviation, which is volatility. Of course, it will all be available somewhere in the exhibits that are given, but may not be, especially the spot and exercise prices are not directly told to you. You have to interpret it by referring to the scenario to find out whether the option is in the nature of a call option or option is in the nature of a put option. While this formula will help you only in calculating the value of a call, subsequently, there has been a call put parity theorem which will help you to quickly calculate the value of a put given a value of a call using the similar variables. So even the call put parity formula is mentioned to you in the examination. Call put parity, where value of a put is value of a call minus the spot price plus present value of the exercise price. Now, as I said, these formulae are mentioned in the ACCA study hub as well as in the textbooks for making you understand them thoroughly. But in the examination of AFM, a pre-programmed spreadsheet is available. Now, although the formula, as I said, or the model, as I said, initially was developed only for European style call options related to financial derivatives that are openly traded, it was archetyped in a way to make it applicable even for the management decision making with regard to the investment appraisal. So there could be certain discussion questions set regarding assumptions and limitations of this model. Especially a student's skepticism skills can be tested for questions on these. Of course, there will not be a theory question asking you what are the assumptions and what are the limitations. But the question could say, okay, to what extent the use of Black-Scholes option pricing model is valid or is relevant for the company in question. And there you should say that, okay, while it gives a proxy of certain estimation, it suffers from certain lacuna, and mainly the assumptions and other limitations will be pointed out by you so that your skepticism skills can be exhibited. First of all, the formula is based only for European style call option. In reality, the real options are not exercisable on a specific day. It could be exercised at any time during a specified time period. So it's not related to European option, but it gives a proxy to some kind of estimation which can help management take these decisions. Returns from the underlying asset maybe in the form of dividends or other return, interest, etc., which are applicable directly for financial derivatives, not in case of real option, but they're assumed to form a normal distribution. It's a concept from statistics. But don't worry, you will never be questioned on how the normal distribution looks like and what it means when we say that the mean is 0 and standard deviation is 1, etc. Don't get into that. But in real life, the returns will never be symmetry. They will keep fluctuating, in a randomly. That's what random walk theory says. But for the purpose of this formula, the assumption is that they form normal distribution. It also says the markets are perfect, so they are not saddled by, taxes or other imperfections, regulations, etc. And another major assumption is investors can borrow at risk-free rates of return, which are not realities in the live case scenario. So you need to mention these 3-4 points when you are answering about the validity of using this model for evaluation of real options. Another thing is when we talk about volatility, fluctuations in the prices, the formula uses historical fluctuations and not anticipated future fluctuations. So that's one of the limitations. Ideally, what one can do is, of course, you can take the history of fluctuations and factor certain things. Thereby, you could estimate what could the fluctuations in the future be and input that in the formula. That will still be okay, rather than following the historical fluctuations blindly. Returns, as I said, do not follow normal distributions, maybe because of extreme market conditions. Geopolitical decisions by the governments of the world will affect the prices of the on the market of the financial derivatives, and risk-free rates don't apply in a real life scenario. How do you apply this model in AFM examination? As I already told you, pre-formatted sheet definitely is available. You just enter the appropriate variables, but you should know how to interpret the result, what it means to you. What's your real test is to be able to correctly identify the spot price and the exercise price from the information that is given to you. Other variables such as volatility, time, risk-free rate, they are usually directly given in this scenario, usually. Of course, this question could be there as a part of 50 mark section A question or a 25 marker section B question. So it could be tested anywhere in the AFM examination as such. So let's quickly look at a practice. Current share price of Caesar is $14. A European at-the-money call option on the share has 1 year before it expires. Risk-free rate is 10%. Standard deviation is 20%. As I said, these are directly given. So if the current price is $14, it is the spot price. In the entire data given, the exercise price is not given, but what we are told is the at-the-money call option. That means there is no profit, no loss, which means the exercise is also $14. We then just enter these 5 variables in the pre-formatted Excel spreadsheet and find out the values. The values of call option and put option are straight away given here. They may be dollars, millions, or whatever. Interpreting them is really crucial to you because in valuing real options, you should be able to say, hey, the real option will add, real option to delay a project will add $1.86 million, for example, to the value of the project. And therefore, it's worth accepting it, although the original traditional NPV of the project is negative. So this is a tool used by finance managers to evaluate investment projects in a much better manner than only using net present value method. These applications are what tested in the AFM. As I said, syllabus area B2 talks about real options. Flexibility to delay a project is like a call option. Flexibility to abandon the project midway is like a put option. How do you determine the spot and exercise prices. All that is available in the ACCA Study Hub. Please go through that definitely. So ACCA Study Hub continues to be a very, very strong resource for you to be able to, learn this topic, highly technical topic, in the best possible manner. Apart from, of course, practice platform that gives you lots of past paper examples to practice on. And don't forget to go through examiner reports, because they could bring out, the limitations and weaknesses of these tools. So in summary, the BSOP model, as it is popularly called, used to value call applicable to the financial instruments regularly traded in the market, but it can be useful to evaluate real options which represent a flexibility to managerial decision making. And in your exams, you must be proficient to make use of the pre-formatted, pre-programmed spreadsheet provided to you. So all the very best for learning BSOP. Thank you very much for watching this video.